Okay, we have waited for like 7 minutes. I think that is enough for where I want to enter this class. So I've entered. So today we are going to make progress. Remember last week on Sunday or Saturday, we moved forward on financial instruments. And from the very beginning of this topic, I already explained to you that we're going to be using these three standards to explain financial instruments, which are IFRS 9, IAS 32, and IFRS 7, but substantially IFRS 9 and IAS 32, because they are the one that deal with the major accounting treatments. For presentation, we spent a lot of time trying to understand the definition as well as how to identify whether an instrument that is issued by an issuer is an equity instrument or a debt instrument. We looked at several scenarios on how to do that. I gave you assignments on how to do that. Because substantially, when it comes to financial instruments, identifying the financial assets is not what is difficult because that's always the investor. But where you need to think a little harder is for you to be able to identify whether an issuer has issued an equity instrument or a debt instrument. That's not even the technical thing. The technical thing is how to then account for that issue. So an issuer can issue ordinary shares, but by the time you look at the substance of that issue, then you find out that it should be treated as a financial liability. And if you remember, I gave you an example where a company usually gives their directors a special class of ordinary shares. But immediately the directors retire or after their time or after that their tenure, the directors, the shares will be buy back from the directors. The company will buy the share back from them. See, for the fact that the company will buy the shares from the director, that automatically give rise to an obligation to deliver cash by the company. And for that reason, we said that ordinary shares issued by the company to those directors, we are going to treat them as financial liability from the onset. So even though the instrument the company issued was an equity instrument, was an ordinary shares, but by the time you look at the substance, it is a financial liability. We also looked at an example where a company bought PPE, property, plant, and equipment, and they agreed to settle with ordinary shares. However, the substance was that the value of the ordinary shares that will be given to that supplier in 1 year's time must be 5 million, which goes to show that the number of shares that the company will issue is a variable number of shares. Is a variable number of shares. And being a variable number of shares, automatically that makes that issue of ordinary shares to be a financial liability. So even though what the company will issue in 1 year time is an equity instrument, is an ordinary shares, but when we looked at the substance, should be treated as a financial liability. And I give you assignments up to now, very few of you have submitted, and those that have submitted, I've shared the solution with them. It's very important that every one of you attempts that. So understanding that is the very basics of IS 32. The remaining part of IS 32 on compound financial instruments, I will get there today. So we spent all our time last week on IFRS 9 because it's IFRS 9 that deals with recognition, derecognition, classification, measurement, and those were what we looked at on Saturday. And if you remember clearly, we mentioned that financial instruments should be recognized when an entity becomes a party to the contract. Then you can go ahead and recognize your financial instruments, whether it's a financial asset that you have, or is a financial liability that you have, or it is an equity instrument that you have. You can go ahead and recognize it when you become a party to the agreement. And you become a party to the agreement either at the date of the agreement or at the date of commitment. I mean, when investments are made or money is received, something like that. Immediately we went on to derecognition. We started with derecognition of financial assets. And I told you that financial assets can be derecognized when two criteria occur. Number one, when an entity's right to the cash flows, to the contractual cash flows, has expired. Number two, when there is a transfer of substantial risk and reward attributable to ownership of that financial asset. Those two must exist, not one. The two must happen before you can derecognize a financial asset. Not one of them, the two. And I can remember that we looked at some scenarios showing that it's not enough that your right to cash flows has expired, but you must have transferred substantial risk and reward. So we looked at scenarios where an entity sold its receivables and collected money, but it still holds, it still has substantial credit risk. It is still giving guarantees to the counterparty that if those customers fails to pay, that they will compensate. I mean, that shows that you have not transferred the risk and reward. And for that reason, we said that it cannot derecognize the financial assets, that it has to continue to recognize the financial asset. We looked at one other examples as well. For financial liabilities, that is derecognized when the liability is extinguished. Extinguished. And extinguished means that the liability is settled, is discharged, or transferred. That's extinguishment. Just do any of those. Then you can go ahead and recognize the financial liability. Then we moved on to measurements. And for that, we looked at measurement of financial assets and also measurement of financial liability. I started with financial assets. I looked at how do you measure cash? Because cash is a financial asset. I told you that the measurement of cash is cash because there is always an absolute value for cash. You can always trace cash to a specific amount. So no issue around measurement. You can always get the amount because you will know it. You will know how much cash you have. Then we moved on to measurement of equity interest in another entity or investment in equity interest in another entity. So when you invest in equity instruments, it simply means you are buying shares. And we said to measure that initially it is measured at transaction price, which is simply the amount you paid for those shares. And I told you again that on the date of acquisition, you must identify your intention for buying those shares. If your intention for buying those shares is for trading or for speculations, then you are expected to classify that financial asset at fair value through profit or loss. But if your intention is to hold it for the long term, that means you should classify that financial asset at fair value through OCI. And the way you classify it is exactly how you're going to measure it at the end of the year. That means for equity investments, they are measured at the end of the year at fair value through P&L and at fair value through OCI. And that was it for equity investments. But I made mention of transaction cost because there's no way you can buy shares without involving stockbrokers. You pay a fee, you always pay a fee when you when you enter into share transactions. There's always a fee. There will be stamp duties, there would be the exchange fees, there'll be brokers fee, all of those fees, they are transaction costs. And I told you that that transaction cost the treatment depends on how the financial asset or how the equity investment is classified. If the equity investment is classified at fair value through profit or loss, then the transaction cost will be expensed. But if the equity investment is classified at fair value through other comprehensive income, then the transaction cost would be capitalized. That is, to be added to the cost of that financial asset. Then I went to debt investment. I said that debt investment is initially measured also at transaction price, which is the amount you have invested. And also at the date of acquisition, you must identify your intention for making that investment. And for debt investment, you need to assess your business model and also the contractual cash flow characteristics. And your business model basically is how you intend to make money. And there are two ways in which you can make money in a debt investment. Number one is you get interest, like periodic interest, and also your principal at maturity. Number two is that in addition to getting interest and principal, you can also sell that investment. I mean, that's when you have an alternative investment that will give you a higher yield. Then you are just better off selling the one you are holding so that you can use the proceeds to buy another investment that gives you an higher yield. And also is the contractual cash flow characteristics, which basically talks about the existence of a contract. We have to say a contract that backs up how you are making money. There has to be a contract that will show the amount of interest you're supposed to earn, when you're supposed to earn it, and the fact that it's tradable, something like that. So that's contractual cash flow. The cash flow must be backed up by contracts. But fundamentally, the essence of this business model test and the contractual cash flow test is for the classification, because this debt investment has to be classified at the date of acquisition. Then how do you go about this? How do you achieve this? If your business model is to collect interest and also principal at maturity, meaning those are the kind of investment we call held to maturity. I mean, you can find it in your exam. They will call it held to maturity because that's your business model. You are holding it to maturity. Such debt investments are usually classified at amortized cost. They are usually classified at amortized cost. But if your business model is, of course, to earn interest and also get principal, but in addition to that, you can also sell. We call such debt investment available for sale financial asset. Available for sale. Those are usually classified at fair value through other comprehensive income. And there is a third one, which is a default category. That is fair value through OCI. That one is fair value through, is a default category. And default category in the sense that an entity can decide right from day one that the way it wants to classify its debt investment is to classify it at fair value to PL. It can decide that, can designate it at fair value to PL. So if the examiner tells you that this entity has decided to classify its debt investment at fair value to PL, then don't argue with them because it is allowed. It's allowed. Then I showed you how to calculate amortized cost. I showed you a scenario that's very straightforward where you issue a debt, not you issuing, you invested in a debt instrument and you're supposed to collect 5% interest per annum for 3 years. That is always very straightforward in the exam because there is usually no challenge with that. Because all you're going to be doing fundamentally is just to recognize your regular interests every year from year 1 to 3. From year 1 to 3, you're just recognizing the interest you actually collect, 500,000 every year. Debit bank, credit P&L. And your statement of financial position, you just describe that investment as financial asset at amortized cost. And after 3 years, they will pay you back your principal, which you debit bank, you credit financial asset, and everything ends there. And I showed you also scenarios where there might be complexity. And that scenario where they will tell you that the principal repayment will be 11 million when the amount you invested was actually 10 million. And I explained this very well to you last week. I told you that this shows that this entity is making two interests. The normal 5% interest, which is the nominal interest rate, and they are also making a premium, which is the extra 1 million. So this guy is not making just 5% per annum, he's making much more than that. So principally, the whole ideology is that that extra 1 million that he's making, even though he's going to get it after 3 years at maturity, because that's when they will pay him 11 million principal. We are saying that don't wait until the end of the third year before you recognize that as income. Because you might want to think at the end of the third year, when they pay you 11 million, so you will debit bank, abi? You will now credit financial assets with 10 million to net it off because it was 10 million you invested. So the extra 1 million, you now go and put that 1 million in P&L. No, you can't do that. That's against accrual basis of accounting, according to the conceptual framework. So the right way to do it is to spread that 1 million over the investing period, over the period. And that's where effective interest rate method comes in. So you find the examiner giving you an effective interest rate. When they give you such, that means that they have already helped you determine a rate that encompasses both the nominal and the premium. So this 8.08% given to you includes both the 5% that you get paid actually, and also the premium as well. So with this now, we can spread that that all-encompassing income over the year. So that's more reasonable. And I showed you two ways of doing that. Is either you use the native method year on year by doing your debit and credit, meaning in year one, the interest income you recognize in P&L won't be 5% anymore. It will be 8.08% of the 10 million. Then you debit interest receivable because you are not actually getting this 8.08%. You're only getting 5% of it because that's the nominal interest. So you do your double entry, debit interest receivable and credit interest income. Then at the end of the year, you actually receive only the 5%, right? Which is 500K. So you debit bank, you net it off against the interest receivable. So the interest receivable balance, since it was 808, we received 500. So there's a balance of 308. That balance of 308, you net it off to the financial asset account. So your financial asset that was initially 10 million becomes 10,308. And that's the end of year one. You do the same process in year two. Just that in year two now, when you're calculating your interest, it won't be 8.08 on 10 million anymore because the balance in your financial asset account is now 10,308. So it will be 8.08% of 10,338, like that. You will do it on and on. But there's a simpler way, there's a shortcut to all this, which is using an amortization schedule. That makes it faster for you because this is really what you're going to do in the exam, the schedule. So this schedule, the way it works is you have a balance go forward that will include the amount you have invested of 10 million. Then you capture your interest receivable, which is 8.08% of the 10 million, which is 828. Then you remove how much you actually received because this 808 includes everything, right? So out of these 808, you are only going to receive 500, which is calculated as 5% of the 10,000. Then by the time you do that 10,000 plus 808 minus 500, you'll be left with 10,308, which you're going to carry forward to the next year. You do the same thing again. You do 8.08 of 10308. You get 833. You'd remove the 500 because the 500 is constant. Don't forget. It's always 5% on the principal amount. It doesn't change. So 500 every year. So you are left with a balance of 10641, which you carry forward as well. 860, 8.08% of 10641 again. You get 860. You remove the 500, you are left with 11,000. I mean, this table leaves us in a position where we want to be because this 11,000 happens to be the maturity amount, how much we are getting paid at maturity. So fantastic. Everything checks out. So as soon as they are paying me the 11 million, I mean, I'll just debit bank and credit this financial asset. It's nails off. Everything goes off the right way. So this is how amortized cost work. So for fair value through P&L and fair value through OCI, I also told you last week that for those also, you will still have to do this table because debt investments, interest are always involved. So you will still do this, especially where there is effective interest rate method or where there is an effective interest rate. Where the fair value issue comes in is we would expect you to fair value these balances at the end of the year. So in exam, probably they will give you the fair value. So if they give you a fair value, let's say the fair value is 10.5. So that means instead of 10.308, it will be 10.5. So the difference will now depend on how you're measuring it. If you're measuring it at fair value through OCI, that means that difference will go to OCI. If you're measuring it at fair value through P&L, that means the difference will definitely go to P&L. That's the technique for all this. So, and that's everything around financial asset. And I also mentioned transaction cost also last week. I told you that for transaction costs, that also depends on how it is classified. If the debt investment is classified either at amortized cost or at fair value through OCI, then the transaction cost will be treated as a capitalized item. You're going to capitalize it by adding it to the financial asset. But if it is at fair value through P&L, you expense that. So I've just practically revised what I've taught you for the past 2 weeks in under 20 minutes. And what I've done, I've just shown you a secret of how to actually read for an ICANN exam. That is how to read. What I've just displayed to you is how to read and pass an exam. You don't read a topic as if you are reading a novel. You don't assume that you know. When you read a topic, you should be able to sit down and summarize what you have read. If you can sit down and write, when I say summarize, not just thinking, no, you sit down and write yourself without looking at the book. You can summarize everything you have read. Like, this is what I understand. And you compare your summary that you wrote yourself with your working notes and they jive. My dear students, you can never forget it. It's not possible. But if you are reading and you're just rushing, I want to finish this one, I want to finish that one. No, that's not how to read, though. You're just deferring, you just be stressing yourself. Do it, you read deep down, you read properly. Just do that. You have read something for 2 hours, then do the summary for 15 minutes, 20 minutes, write it down. If you can do that, then you're done with that topic. Now, we have done the major work. You see, what is left is financial liability. And lucky for us, financial liability, this is measured in the same way, the debt investment is measured. Debt investment is measured. So everything you learned, I've mentioned about debt investments is the same way, in the sense that first, financial ability is initially measured at transaction price or net proceeds. But net proceeds majorly, net proceeds in the sense that is transaction price minus transaction costs. I'm mentioning transaction costs. For financial assets, we usually add transaction costs. We usually add it because it's an additional cost. Okay. But for financial liability, look at it. For financial liability is not for you when it is a cost to you, but it's going to impact on how much you are going to collect. Because in this case now, you are the one collecting money. You hired a broker to help you broker collection of borrowings. Like you're raising a commercial paper, for example, now you're raising instrumentary commercial paper, and usually companies will use a registrar that will account for the subscribers and all of that and do all the documentation for you. All they will just do is just to send you the money. Those guys will charge you like 5% or thereabout. So if all the money they are collecting on your behalf is 10 million, be sure that they won't send you the whole of the 10 million. They will send you net of their fees and all taxes. They will send you net. So no problem. That's fine. So IFRS 9 says that since we know that is net they will send you, yes, so put it in your books at exactly how much you received, which is the net proceeds. And that's what we are saying here. So don't forget, you see them in your exams like that. Again, this also, it is also classified. It is also classified based on business model tests and contractual cash flow tests that I explained earlier on contractual cash flow tests. Okay. And these tests determines whether the financial liability should be classified either at amortized costs, fair value to OCI, fair value to P&L. The same thing that I taught you in all of this would apply. And again, financial liability is subsequently measured at either these three as well, right? So if I want to give an extended example, let me just use this example here, so I won't have to rewrite it again. Okay. So Wasiu acquired, in this case now, it will be Wasiu issued. Okay. So if you are investing, that is when you acquire. But if you are the one that is borrowing money, that means you are the one that will issue the instruments, okay? So let's say you issue 10 million naira at a nominal interest rate of 5%. So the period of the issue is 3 years, at which date the principal repayment will be 11 million. Okay, let me add that the the issue cost, or transaction cost is, let's say 200,000. 200,000. So, and they say the interest rate is let's say 8.85. 8.85. So we're now asked to account for this. So similar to what I've done, yes, we have balance brought forward, interest payable, interest paid, balance carried forward. So all of this will be currency. Let's say the interest payable will be the 8.85%. This will be 5%. Okay, so year one, which is 2025, we borrowed 10 million. Abi? But if you put 10 million here, you'll be wrong in the exam because the standard says that this is initially measured at net proceeds. So what you're expected to put here is actually 9,800 and not 10 million. You're supposed to put 9,800, not 10 million. So the interest at 8.85%. Who can do 8.85% of 9,800 for me?
Sorry, sir. Good evening, sir.
Hi, Emmanuel.
Sorry, I have to ask this, but so how did you get 9,800?
Oh, it's 10,000 minus 200.
Now,
200.
867.3, sir. 867.3. The interest rate, sir. 867.3. Yes, sir.
Okay. So I'm with you. So Emmanuel, this 9,800 is the 10 million, which is the amount we're supposed to borrow, minus 200, the
Oh,
transaction
okay.
cost.
That
You
is the
know
net
that
proceed. Yeah.
yes, exactly. This 98 is the net proceeds.
Okay. Thank you, sir.
You're welcome. Yeah. So you have to be asking questions. So anything you don't understand, don't overlook it. Just ask so that you will not be looking for it later when you're revising. Okay. So what will be the interest paid?
$490, sir.
490.
490. Yes, sir.
But you know this is wrong. This is actually wrong. It can't be 490. I know that. How did you get your 490?
That is a
5%
9,800
of
by 5%. Yes, sir.
uh, it cannot
5% of
work.
9,800.
Yes, it cannot work that way. It's still going to be 5% of the 10 million because this is the actual interest that we have to pay to the investors, people that give us money. So we cannot shortchange them and say that because we incurred issue costs, so we will now pay them their own interest based on 9.8 when the actual money they gave us is actually 10 million. So even though we have incurred issue costs, we are still going to pay them interest on their principal. So this nominal interest rate of 5% is still going to be charged at the principal amount of 10 million. You see, this is just similar to when you go and borrow money from the bank and they charge you management fees and they hand over the net to you. So even though they are handing over the net to you, when they are calculating interest, it's still going to be on the principal, and because that's the assumed amount that they actually gave to you. So please don't forget that. So what's the balance here?
Is 93, sir.
9,000.
Yes, sir. 300.
You are approximating. It can't be 9,300 though. 9,800 plus 87.3 minus 500. How can you give you
10,167.
That's 10,167.3.
10,000?
167.3.
Yes, this is more like it. 10,167.3. So in year 2, which is 2026, we'll bring forward the 10,167.3. Let's calculate 8.85% of that. How much?
899.8.
900, I would say 899.81.
Okay. And here will be how much?
500.
500.
Thank you. Doesn't change. And what's the balance here?
399.8.
399.8.
Sorry, sir. Sorry, plus this.
Yeah, you add it to this.
10576.1.
So 10,576.1. So what's 8.85% of this?
Please check it. I don't know if I'm right. I got 10,867.1.
Sir,
You got 10,000. Can we confirm, please? 10,167 plus 899 minus 500.
10,567, sir. 10,567.1. Then the 8.85%, sir, is 898.
No? Okay.
898.8.
No, sir, 898.2. No, sir, is 2027 I'm talking about. 2027 I'm talking about.
Why this way 26 finish? Okay, 20.7.
Okay. So 2027 is how much?
898.2.
No, sir. It's 935. Approximately 936.
935.19.
Okay. And this is how much? 500. So what's the balance?
One 11002.
That's approximately 11,000. So which is still where we want to be, which is what we are going to get paid at maturity. This is what we will pay at maturity. Okay. So this is all. So this is all. So from this schedule now, what goes to P&L is this interest that we got using 8.85%, because it is this rate that encompasses everything. This 867, this 899, this 935, they all go to P&L. They all go to P&L because it encompasses both the nominal interest and the premium that we are paying. While these are the balances, these are the balances of your financial liability account at the respective years. And you see the way it's progressing towards the 11 million. That at maturity, we were at that 11 million. And that is the amount we are going to settle. So it makes sense that that is actually the balance. And that is what effective interest rate method does for us. It has spread those interests over the 3 years, that we automatically get the repayment value at the end of the 3rd year. Okay. And that is it for financial liability. Now, let me go to compound financial instruments. Let me go to compound financial instruments. So, do you have any question before I go to this one?
Yes.
Okay, Sarah.
Please, how did you get balance BF? Balance CF? I can't remember from last week.
See this one
Yes.
is 98 plus 867.3 minus 500.
Okay, minus. Okay. Thank you.
And that's why it's in jacket.
Okay. That's all.
Hello, sir.
Yes.
Please, what was the full meaning of that FVTOCI and FVTPL?
Fair value through other comprehensive income and fair value through profit or loss.
Okay, thank you.
You're welcome.
So did we stop because we got to 11 million or because it was 3 years already?
Because it's 3 years already.
Okay.
Hello.
Yes.
Hello, sir.
Yes,
Please,
I'm
the last one for the last year, 2027. If I do my arithmetic, the balance carry forward is 11,002.3. Are you putting 11 million naira because we are expecting that the repayment at the end of year 3 will be 11 million? Is that why you did not include the 2 naira and 3 kobo?
Yeah, you can include it now. It's immaterial as far as we are concerned. It's approximation error.
Okay.
Any other questions? Okay. So let's go to compound financial instruments. Please, let's pay attention. So I'll try to be very direct, straight to the point, because from your voices, everybody just sound very tired. I don't know why. So, to compound financial instrument, you see, this is an instrument. This is an instrument that has the characteristics of equity and debt instruments. He has the characteristics. He has the characteristics of the two of them. So imagine you want to raise money. You now raise using an instrument, and this instrument has the characteristics of both equity and debt. And examples, in fact, not even examples. Example of a compound financial instrument is convertible debts. And from the name, you will see that convertible debts are debt instruments. You see, they are primarily debt instruments that the holder of the instrument, when I say the holder, I mean the investor, the person that gave us money. The holder of the instrument has the option of either collecting cash at redemption, or collecting ordinary shares. So, and that's where the name convertible is coming from. So the convertible is coming from the fact that these debts, you can convert it to shares. These debts can be converted to shares. So that's the substance here. So now, you see, so primarily, it is a debt. You borrowed money. But the person that collected the money, the person that borrowed the money, has given you like an open check. And he said, my dear investors, when you want to collect back your money at maturity, you can choose to say, okay, don't give me back this money. Rather, give me shares. Give me shares. So the challenge for us is this. Because the examiner is going to ask you this question from the standpoint of the issuer, not the investor. It will be from the standpoint of the issuer. So this issuer now, how do we account for this debt instrument in his books? Because we don't know. We are not sure whether the investor will convert to shares or he will collect money back. And why this is a challenge is this. If normally we are going to give back the investor their cash, then this instrument would account for it as a financial liability. because financial liability is an obligation to deliver cash. So that's the financial liability. But if we know right from the beginning that at maturity we are going to issue shares to this investor, then in that case, we're going to account for it as an equity instrument, even though if what we have issued is debt. But if you know right from the outset that we have to issue shares to pay back, then right from the beginning, the substance is that of equity. Because in that case, we don't have obligation to deliver cash. But in this case now, we don't even know whether the investor is going to collect cash or shares. We don't know, because the redemption or the mode of redemption is at the option of the investor. It's the investor that will decide how he wants to do it. So because of that, we'd expect, so you see, let me put it for you so that when you're revising. So because the issuer does not know whether the investor will opt for cash redemption or share redemption. We therefore have to account for this instrument to reflect elements of both debt and equity instruments. So how do we do this? So deposits, so to achieve this, the issuer must separate the deposits from the issue into debt and equity instruments. So to do this, we will determine the value of the debt and ascertain the equity instrument as the balancing figure. So how do we do this? Let me show you. Let me show you how we do this. So if you look at this, question. It says a company issued 20 million of 4% convertible loan notes at par on 4th January 2021. The loan notes are redeemable for cash or convertible into equity shares on the basis of 20 shares per 100 naira of debt at the option of the loan note holder on 31st December 2024. Similar but non-convertible loan notes carry an interest rate of 9%. Required. Show how these loan notes should be accounted for in the financial statements at 31st December 2021. Now, because the instrument is a convertible loan, and it is clear that the redemption can either be at cash or converted into shares. So on the basis of this, is just so irrelevant for us here. The basis of conversion is irrelevant. What is relevant is that now we know that the investor can either decide to collect cash or convert it to equity. So we don't know which option he would choose. So, I told you that therefore, the investor, not investor here, the issuer would have to treat this instrument as a compound instrument by reflecting the element of both equity and debt. And to do this, you will need to determine the value of debt first. And why are we determining the value of debt first? Because according to definition of equity instruments in everywhere, both in a conceptual framework and in IAS 32, equity instrument is a residual interest, the asset of an entity after deducting all liabilities. So equity instrument is always determined as the balancing figure. So we need to determine the financial liability value first. So to do that, it is established that the amount borrowed is 20 million. That one is an established figure. He borrowed 20 million. So what we want to separate is this 20 million. This 20 million that we borrowed, we need to separate it into debt and equity because we don't know whether we should treat it as debt or equity. Then the solution is to separate it, treat it as both debt and equity. So let's get the first is determine the financial liability element first. Now, those of you that are doing, I see Asiwaju teaching you bond valuation. So can anybody tell me, from your knowledge of bond valuation, how do you think we'll have determined this valuation of financial liability? Because bond, when you issue bond as a financial liability, can you bring forward that knowledge here? How do you think we would have done that in this case?
We'll find the present value of the bond, of the debt.
Thank you very much. That's absolutely correct. Is that what they taught you there, Ruma?
Yes, sir.
Okay, that's fine. So that means it's the same, it's applicable here too. So all we need to do is just to get the present value of this financial liability of the issue of this 20 million. And to do that, we'll get the present value of the annual interest and also the present value of the principal. So the annual interest is for how many years? We issued the loan in 1st January 2021. The maturity is 2024. That's how many years? 1, 2, 3, 4. That's 4 years. So that's 1 to 4 years. First, we'll get the present value of the interest. How do you compute the interest? The nominal interest is 4% times 20 million. How much is that? What's 4% of 20 million? 4 times 2. Is that 800,000?
Yes, 800,000.
Okay. So let's get the present value. We'll get the present value using the market rates. We cannot use the 4% though. This one cannot be used to discount. We use market rates. And they already give us market rate as 9%. Similar but non-convertible loan notes is 9%. So we use 9% for our discounting. So what will be how do you get the annuity factor? How do you get the annuity factor?
We use the annuity formula, sir. Annuity factor formula, sir.
Okay, annuity factor formula. which is 1 minus 1 plus r raised to power
3.24.
minus n, Abi,
3.24.
N
over what?
divided by R.
Over, okay. So, can you press this on your calculators?
3.240 approximately.
3.24 approximately.
And you know that there will be some of you here that will not know how to do that. And they will not talk. So if you multiply 800,000 by 3.24, how much should I give you?
Two five
2,592,000.
2
two
million,
five yes
592,000.
592,000.
like this.
Yes, sir.
Two
Okay.
five and 92.
No,
2,592,000.
590.
2592.
Zero. Remove the zero, sir. Remove that zero. Remove it, sir.
92. Yes,
Yes,
sir.
correct.
And now
That's
when you people you are calling figure like as if you are the bus stop. Your accountant now, you say 2,592,000. You are calling figure 2592, 2692. What's that? Then we would also determine the present value of the principal amount, which is paid in year 4. Yeah, this interest is paid every year, and which is why we are using annuity formula, because the 800,000 is per annum, and whenever we want to get the present value of annual amounts, we use annuity factor. So we would also get the present value of the principal amount, which will be paid in year 4. And the principal amount is 20 million. So for that, we use the discounting formula for that. We cannot use annuity for that. That one is a future value that would need to get the present value. So we just do 1 plus r raised to power minus n. So what would that give you? What would that give you? If you do 1.09 raised to power minus 4.
0.784. No, 7084. 70.
Like this. Let's say 708. 3 decimal places. So what do we have here? Whoever is calling figure, call figure to me like an accountant. This is an accounting class.
$14,160,000.
Good. Okay. So now I can then sum the two together. If I sum them together, what do I have?
$16,752,000.
Okay. Now, you see, don't forget that this determination, this separation, we are doing it at the very beginning of the year. before we even enter this transaction in our books, at the very beginning, that's the first thing you would do. So we have gotten the liability amount. So I just need to compare that with the sales proceeds, which is 20 million. So whatever the balance would be, my balance becomes my equity instruments. So what's the balance?
20,248,000.
Okay. 3,248,000. So that means that at 1st January 2000 and what again? 2021, when we collect the money, we simply debit bank with the 20 million that we are collecting. We'll credit convertible debts with the financial liability. We'll credit equity instruments under equity with 3,248,000. So this is what goes to financial liability. This is what goes to equity. So now, with these figures now, at the end of the year, you see, my equity instruments will not change. It still remains, it will be like this all through, year in, year out. But you see my financial liability, that one will change because of interests. Because you have to pay interest on financial liability. And in this case now, since there is even an effective interest rate, so we have to use amortized costs to determine the value of our instruments. So let me use the table that you're familiar with. So at the end of 2021, the balance brought forward was 16,752. This figure that we got here. Then I will get my interest payable at 9%. I'll get my interest paid at 4%. And then I'll get my balance carry forward. So can somebody get me my interest paid at 9%? What is 9% of 16,752,000?
1,507,680.
Okay. Can somebody get me my interest at 4%? I know you'll get it wrong, but still say the wrong figure.
It's 800,000.
Ashiri. That's correct.
Sir, sorry, I didn't get it 100,000, sir.
I know now. I know you're going to do 4% of 16,752. When I already taught you that
20 million,
this
sir.
nominal interest should always be calculated on the 20 million. So which is 800,000. So what's the balance? This will be in jackets, the deduction. What's the balance? Yeah, no. I don't want to stay here forever.
17 million 150,680.
70 million for what?
59. 680.
Okay. So those are my figures. You see, just that we don't have time and you might not be required to do that. If I continue 2021, 2022, 2023 for the next 3 years, my final figure that I will get should be 20 million at the end of the day, but you can be doing that yourself. So in your statement of profit or loss, in fact, let me start calling it for you the new name, statement of financial performance. I will have to teach you guys IFRS 18, which is a standard replacing IAS 1. Anyway, it's not like it's in your syllabus, but ICAN requires you to know all standards. You need to have knowledge of all the standards. So one way or the other, I will have to find a way to touch most of the key standards beyond the ones I've even identified for you guys. So IFRS 18, I've come to replace IAS 21. I said IAS 21, IAS 1. And IFRS 18 was issued in 2024. It becomes mandatorily applicable from 2027. And early adopters should start from 2025. People can start adopting it. But since you have to present your financial statement from 2027 using IFRS 18, and any new standard is applied retrospectively, that means the comparative information, which is 2026 accounts, must be prepared in accordance with IFRS 18. And your exams, anytime they issue a new standard, 6 months after the issue, I can test it. And I'm 100% sure that you find it all over your exams, both in corporate reporting and those of you that are doing case study. We're also going to meet you. I'll be teaching you guys case study. It's a very interesting, it's a guaranteed pass for all of you that will be in that class, but it's a very practical class, and teach you all of that. I'm sure you are going to see it in that regard also. So I'll be calling it statement of financial performance going forward. And this finance cost here that goes to POL, I taught you already that is this amount, the effective interest that will show there. Why in my statement of financial position under my non-current liabilities, I will have my convertible debts. This is the balance that will be there. Why under my equity? Let me call it option to convert. It was 3248. 3248, yeah. So that's that for this question. Is no more than this. Any questions? Okay. Now,
Hello, sir.
yes, Christopher.
If we are to spread it according to, if we are to do more than that 2021, as we said that we should do the rest ones. That means for the statement of financial performance, we are going to put 2021, 22, 23, 24, just like that. Then we'll pick it in line along with the years, the figures that we derive.
Yes, that's correct. Yes, that's correct. So for each year, will just be the figures. Okay. So, what I'll do now is just to solve questions for you on most of these things, these principles I've been teaching you. Ordinarily, the next thing is for me to teach you impairment of financial assets, but I will not go there this evening. So let's just solve some questions. But before then, let me be sure that you understand that interest payable to, or interest payable on financial liabilities is treated as a finance cost. So finance cost in your statement of profit or loss. Why dividend payable on equity instruments? Equity instruments is treated as a deduction from retained earnings. Also, the issue costs on equity instruments is treated as a deduction from share premium. I already taught you issue costs on financial assets. I told you that one is added to the financial assets or expense, depending on how the financial asset is classified. And for financial liability, issue cost is usually deducted from the proceeds of the issue, while issue cost on equity instrument is treated as a deduction from share premium. Like that. It's important you note all of that. Okay. Let's solve this question. Let's solve these questions here.
Please hold on. I'm copying those 3 notes. Sorry.
Okay.
It's okay, sir. Thank you.
Okay. Can any one of you read this question for us?
Okay. Can I read now?
Okay, yes, please.
Okay. On 1st January 2010, Number purchased a debenture for 2,000 naira. The debt instrument is due to mature on 31st December 2014. The instrument has a principal amount of 2,500 naira, and the instruments carry a fixed interest at 4.72% that is paid annually. The effective interest rate is 10%. How should Number account for the debt instrument over its 5-year term.
Okay. So number purchased a debenture for 2,000. So this shows that number is an investor. Since he's the one that is purchasing, is therefore an investor. So the debt instrument is due to mature in 2014. So that means the period of the investment is 10, 11, 12, 13, 14.
Yes.
That's 5 years. We're told that the instrument has a principal amount of 2,500 and the instrument carry a fixed interest of 4.72% paid annually, and the effective interest is 10%. Okay, so how do you account for this? So over the 5 years, so that means your best friend in a question like this is always amortization schedule. We're talking about a debt investment. So you have here balance brought forward, interest receivable, interest received, balance carried forward. So this interest will be, the effective interest is at 10%. The nominal interest is at 4.72%. That's so in the first year, at the end of the first year, the guy invested how much? 2,000. Invested 2,000. The interest receivable, that will be 10% on the opening balance, which is the
200.
interest. That's 200. The interest received is always calculated on the principal amount. So a lot of you will have failed this because you will have done 4.72% of 2,000 instead of 4.72% on the principal amount, which is 25. So can you get me 4.72% of 25?
Yes, sir.
118.
118.
118.
Sorry, 118.
Good. So what's the balancing figure?
Hello, sir, please, how did you get the 118?
4.72% times 25 times the principal amount.
The balancing figure is 2,082.
Okay. So I'll carry it forward. My interest receivable is still 10% of the opening, which is 208.2. This one is will always be on the principal amount. It's a fixed sum, fixed amount every year. So how much is the balance carried forward?
$2,172.2.
2,001 what?
2,172.2.
Have I written it correctly?
Yes, sir.
Okay. How much do we have here? So 7.2. This is still 118.
2,271.42. 42.
So this will be 227.1. What's the balance?
$2,380.5.
What's 10% of that? What's the balancing figure?
2,500. 2,500.
Okay, so this is the same thing as the maturity amount or the principal amount in this case. And like I've taught you, what goes to P&L in each of the years as investment income will be this interest receivable, because it is this one that encompasses both the interest and the premium. The interest receivable, that's what will go to P or L, these figures here. Why these balances will be my financial assets at amortized cost. That will be the balances of my financial assets at the end of each year until I get to the maturity date where I would collect my money back. They will pay me my 2.5 and I'll net off the financial asset account and everything closes out. Any questions? Sarah, you can see your hand.
Where did you get 118?
Is 4.72% times 2,500. So the interest received, the nominal interest is always calculated on the principal amount.
Was
It's
that what
always
you did the
calculated on
other
the,
time?
yes.
Eh,
So all other times, those examples I gave you, the principal amount was the same thing as the amount we borrowed.
oh,
Was the same thing as the amount we borrowed. But in this case now, the examiner twisted everything for us and said that, okay, this maturity amount is the principal amount.
okay.
In those other one, the maturity amount were not the principal amount because maturity amount is not the same thing as the principal. But in this case, they said it is.
But how is it? This is 2000, this is 2005.
So this financial instrument, they can structure it in whatever way. Financial instrument can be structured in any way that suits both the issuer and the investor. So maybe this one was issued at a discount, right?
Okay.
So
Okay.
saying that, okay, I want to borrow 2.5, but give me 2,000. Give me 2,000. So that means, as far as the guy is concerned, he's going to be getting interest on 2.5.
Okay.
They can structure it in different ways. I mean, it's a long story. I'm just focusing on what we need to know. I mean, by the time we start talking about securitization, by the time we start talking about what happened during 2006-7, during the subprime, the mortgage era in the US that catapulted into financial crisis, they're just playing around financial instruments, structuring it in whatever ways that suits them, securitization or pawn securitization and all of that. But here we are keeping it simple to what concerns us. So that's why this one is computed on the 2.5 because that's the examiner was very specific. He said is the principal amount. Do we have your permission to continue?
Oh, sorry. Yes.
Okay. Second question. Can you please read for us? The guy that read the first one.
Okay. Okay. On 1st January 20X18, Latino acquires a quoted investment in the shares of SA Limited with the intention of holding it in the long term. The investment costs 400,000 naira. At Latino year end of 31st December 20X18, the market price of an identical investment is 475,000 naira. How is the asset initially and subsequently measured? Latino Limited has elected to recognize changes in the fair value of the equity investment in other comprehensive income.
Thank you very much. The examiner said that how is the asset initially and subsequently measured? Okay. So initially he's talking about the date of acquisition. So Latino actually acquired shares. So this is an equity investment. And he said the intention is to hold it for the long term. That means he's going to classify it at fair value to other comprehensive income. And the investment cost 400,000. I can't see any transaction cost here. So that means this equity investment, this equity investment will be initially measured at the transaction price and transaction price of 400,000. A transaction price of 400,000. So subsequently, which is at the end of the year, subsequent measurements will be at fair value to other comprehensive income. And so the fair value at the end of the year, the fair value at the end of the year is 475,000. The changes in value, changes in fair value of 75,000 will be recognized where? Other comprehensive income. Because they already told us that this guy will measure this at fair value to OCI. They don't even need to tell you because his intention of holding this equity investment is for the long term. So when he's holding for the long term, he will definitely measure at fair value to OCI. So that changes in value between the beginning and the end. That gain, we'll recognize it to OCI. We'll recognize it to OCI. If he was measuring it at fair value to POL, then that gain will have gone to POL. That gain will have actually gone to POL. That's the end of this question.
Hello, sir.
Yes, Christopher.
Okay, what of, for instance, during the course of this transaction, the transaction price now is now higher than the market price?
We have a loss, Abi.
Yes.
Is that what you're saying?
How do we treat it? Yes.
Still go to OCI. Yes, let's say in the next year now, you know that this year it was 475. Next year, it now came to 450. That loss of 25 will still go to OCI.
Okay.
It will still go to
Okay.
OCI. Yeah. As a loss. Okay. Please read the next question for us. Okay. The guy that used to read have slept off.
Okay, I have not slept though.
Oh,
Okay. In January 2018, Cash Limited purchased 40,000 naira, 1 naira listed equity shares at a price of 2 naira per share. Transaction costs were 4,500 naira. At the year end of 31st December 2018, these shares were trading at 3 naira 50 kobo. A dividend of 20 kobo per share was received on 31st October 2018. Show the financial statement extracts at 31st December 2018. I mean, at 31st, yes, 2018. Relating to this investment on the basis that A, the shares were brought for trading, conditions for fair value through other comprehensive income have not been met. B, conditions for fair value through other comprehensive income have been met.
okay. So the question said that show the financial statement extracts at 31st December 2008 relating to these investments on the basis that the shares were bought for trading and conditions for fair value through OCI have been met. That means that will be for the long term or something like that. Okay. So that means the examiner wants us to account for these equity investments using both basis of measurement, fair value through other comprehensive income and fair value through PLL. So the A part is when you are classifying it at fair value through PLL. So how does this work? Very straightforward. So first, they ask for statement of financial statement extracts. So let me start with statement of profit or loss. Now, what happened? I'm used to this. Okay, yeah, I can call it, doesn't matter. Profit or loss for the year ended. Okay, so I bought 40,000 shares at 2 naira. Transaction cost is 4,005. I know that I already taught you that for equity investments, when it's measured at fair value to or classified at fair value to PLL, transaction cost will be what? Expensed. So it goes to PLL. As at the year end, these shares were trading for 3.50 kobo. So that means there is a fair value surplus at the end, fair value surplus of 1.50 kobo times 40,000 shares. What does that give us? That should be 60,000 as an income.
60,000, sir.
Yeah. So he also comes to POL because it's at fair value through POL. And also, I can see dividend received of 20 kobo per share. That will be 0.2 times 40,000 shares. So that would be 8,000 naira. That would be 8,000. So all in all, this is my statement of profit or loss. And I know you will know how I got this 1.5. It's 3.5 minus 2 naira. So in my statement of financial position, as that year ended 21st December 2028, under my non-current assets, I'll have my financial assets at fair value through POL. At the end of the year, the valuation will be 3.5 times 40,000. How much is that? That would be 120. Is that not 140?
You are correct, sir. 140.
Okay, 140. So that's it for that. The second one, which is fair value to OCI, for that, if I prepare my statement of profit or loss for the year ended, now my transaction costs will be capitalized, so that will be added to my financial assets. Also, these gains, fair value surplus, will go to OCI. That the only thing that comes to POL is just the dividend received. Just the same thing here. That's the only amount that comes to POL. So if I do my statement of other comprehensive income, for the year ended 31st December 2008, I will have my fair value surplus, which is this that we got here, the 1.5 times this. But if I do it like this, to a large extent, I'll be wrong. I'll be wrong if I do it this way. If I just do 1.5 times the number of shares in this case, and the reason is this, my fair value surplus here, because my initial investment was 2 naira times 40,000, which is 80,000. And at the reporting dates, the value is now 3.5. So the value has gone to 140. However, don't forget that since we are looking at fair value through OCI, it means that this transaction cost will have been capitalized, which means that at the beginning, it will have been added to the initial investments, thereby giving me a surplus of just 6,500 in my other comprehensive income. So I have to be very careful with that. At the end of the year, my statement of financial position I have my financial assets, OCI, still this. Just like this. Okay. I'm tired already, so I'll just stop here for now. You can do this as assignments. They are not beyond what I've taught you. It's the same. And this one on compound financial instrument is similar to the one I solved for you. You can do it as assignments. I think I've already solved this one, so just cancel this. And there are some past questions here. All these ones that I wrote, skills, professional, and all of that. I can just review them, but I might be having class with you guys on Saturday. I say Saturday. On Sunday, after your case study class, might be doing 10 to 12, or I just want to solve past questions I just want to review past questions with you for maybe 1.5 hours or 1 hour, just to see most of these things we have been solving in class, to open those past questions live together and look at them and see. So even though these are the questions, these are past questions you have here, what I will share with you today. So we're going to stop here for tonight. On Saturday, I would be teaching you impairment of financial assets and IFRS 13 on fair value measurement. Let's see if we can finish it, fine. If we cannot, we'll continue on Wednesday. But those are the two things I want to teach you. So I'm supposed to even start group accounts next week. And it's going to take us like maximum of 7 classes back to back. And this group account is very straightforward. So it's just for you to get the principles of cancellation and adding together transactions with third parties that are outside of the group. Then look at some other variations, disposal, foreign subsidiary, and all of that. So it's not a big deal. The most important thing for us at your level is not even the group account, because you need to have very good knowledge of all these standards. So I'm going to move group account forward by another 1 month. I want to bring forward those standards. I want to treat them early enough in the diet, not later. So I'll be focusing on other standards like IFRS 16, IAS 36, IFRS 8, IFRS 15, a lot of all of IAS 21, a lot of all of those. So would do our best in August to do as many as possible, and even the IFRS 18 as well. So that when I'm teaching you group account, I'll be using that new template for IFRS 18 to teach you, to show you how those accounts should be presented. And the reason I'm doing that is that by the time I'm teaching you group account and want to solve past questions, then you will not be happy to now see that to even solve those question 1 in corporate reporting requires very good knowledge of accounting standards. So we'll now be going back to standards again, doing those intervening periods. So we're going to spend a lot of our time doing standards in August. Then September, we'll do a lot of, we'll use that for group accounts. It will only take us 3 weeks, or let's even give the whole of 4 weeks, September to the principles of group accounts. Then in October, then we'll come back to things like ratio analysis, sustainability framework, then revisions and some other standards that I need to also show you and all that. So basically that would be typically all of that. So that's it for corporate reporting. I'm not sure you guys have done any class on case study, because our approach for case study is that for those of you doing case study with us. So our approach for case study this diet is quite different, because we want to be more exam focused, because case study is not like any other course. It's actually different from other courses, because case study requires knowledge of performance management, knowledge of strategic financial management, knowledge of strategic business reporting that I'm teaching you, and also very good knowledge of report writing to do that. And also, of course, analytical skills. So myself and Mr. Ali will be taking you case study, and he will be starting. He would teach you the same thing he's teaching you in SFM. For those of you doing SFM, it's the same, like almost the same. You'll see he would be having his first class this Sunday. So instead of SFM, it will be case study. So you'll be taking models, the models part, just to teach you how to analyze external environment and internal environment. I see that last week he taught you Pestel and Diamond's theory. You'll be repeating such in case study as well. But the core of case study, which is where I will come in, is the report writing itself. And you will see that case study itself is practical. And the way we're going to teach you is that I'll be starting case study from the last weekend in September. We're going to be having 7 classes. And those 7 classes is not teaching you what is report writing, what is executive summary. No. We would immediately start showing you how to analyze those reports, how to do financial statement analysis, how to do financial data analysis, how to then use those tools to apply your own judgments to the cases given to you, and also how to make recommendation and conclusion. And the most important part is executive summary at the beginning of your report that is always required at every diet. So we're going to be solving cases right from day one. We'll start solving cases, we'll start analyzing it, exactly what you need to do. So we'll do that for 7 straight classes. And the 7th class or the 6th class will be the unseen that ICANN will release. By the time ICANN releases the unseen, we would already be used to, because that's what I would have been teaching you basically. So we'll just do what we have been doing with the unseen. Just that, I said, with the pre-seen, I mean. So by the time they release their pre-seen, we would look at it together, we'll analyze it. We would assume some unseen. That's if they give us financial statements that they are the financial statement of the company, we'll look at it, but we'll analyze it and get you ready for the diet. But be rest assured that we have it planned exactly what we want to do for that course. We have it planned, like a robust framework for you to do well in that regard. I just needed to mention it for those of you that are here. So we would mention it in a bigger space for others that are not here also, so that they would also know that we are coming big for that. Okay, so let me just rest it here for tonight. We will continue our conversations on Saturday. So Sarah, I can see your hand up.
Yes, what is pre-seen? Is it exactly the question that will come out in the exam?
No. So case study, the examiner will give you an idea of what they want you to know. So pre-seen will majorly contain like a story around a company. They will tell you about the external and internal environment of that company. So they can start from the Nigerian economy. They'll tell you about Nigerian economy. Then they will tell you about the industry in which that company is operating. Then they will tell you about the company itself, right? So they will give you like a context. It's like giving you a context that, okay, with this context, that's the pre-seen. When you now get to the exam, they will now show you the unseen. So the unseen can now be the financial statement of the company, right? It will be the cost analysis of the company and also what they want you to do. So usually what they want you to do are 3 things or 4: financial statement analysis, financial data analysis, then they'll ask you to apply your judgment to write a report on that. So that will be the unseen. And that, so by the time we start that analysis of report, you get used to it, because you see that from diet in, diet out is almost similar thing you need to do. So which is why you are not seeing us teaching case study like the way we are teaching these other ones, because that would be a mistake. That would be a total waste of our time. So I want to train you, like it will make sense for me to have even taught you ratio analysis here. You know ratio analysis here. For those of you doing SFM, good luck to you, because you would also gain. Mr. Ali is already teaching you models. You need it also. For those of you that still remember how to calculate break-even point, contributions, for those of you that knows how to do forecast and projections, budgets, you will need all of that, because those will form your appendices. But not to worry, we would cover all of that, because my plan is to do at least 5 diets. So by the time you're able to solve cases on 5 diets together, then you will be fine. But that is the unseen. They will give you a context, like what you should know, so that when you get into the exam, you will spend more of your time on calculations, your appendices, before you start your report writing, not understanding the context again. That's unseen. That's pre-seen. Okay. So guys, I will see you on Saturday. Bye.
Thank you. Good night.
Yeah.